10 investing tips that every beginner should know from day one. When it comes to investing, I've learned a few things over the last few years. I'm no Warren Buffett, but the investing advice provided below has served me well. 1. Understand why you're investing. If you don't know why you're investing your money or what your goals are, you'll make mistakes and lose sight of the big picture. And, no, becoming wealthy should not be your goal. It will lead you down some dangerous paths or cause you to make poor decisions. You can certainly become extremely wealthy through investing, but you must set more attainable and long-term goals. 2. Read investing books, and continue to. While you should participate in your company's 401k or open an IRA, the biggest mistake you can make is to invest your money too quickly. While stock investing is not overly complicated, there is a lot of information to take in. Even if you are a seasoned investor, I recommend diving into some of these personal finance books and continuing to learn. I've read a few books several times and each time I learned something new. 3. Never invest in something you don't fully comprehend. Although this may seem obvious, you'd be surprised how easy it is to fall into a trap when dollar signs flash in front of your eyes. One of the best investing tips I can give to any beginner is to start with what you know. Please read about it, understand the history of your investment, conduct research, and so on. Following the herd may strike gold, but chances are you'll lose money before you win. 4. Stay away from investing fads. That last investing tip nicely leads into this one. Avoid investing fads or when everything is buzzing about something. Remember when cryptocurrency was the only thing on everyone's mind? During the Bitcoin hype, everyone's mother, father, grandmother, and mailman were talking about investing in digital currency. Most people didn't know much about it except that it made people millionaires and caused the price to skyrocket. Typically, this is when it is best to remain on the sidelines. 5. Become defensive when people are greedy. When others are greedy, you should be more cautious and protective of your investments. As I previously stated, when everyone is optimistic about the economy, investing, and talking about it, it may be time to take a step back. It doesn't mean you should stop investing entirely, as dollar cost averaging is a great long-term proactive strategy for your 401k or IRA. However, keep an eye on the overall sentiment surrounding the stock market or economy. 6. Be greedy when people are afraid. Furthermore, when people are afraid of the markets, it's probably a good time to get more aggressive. While a bear market or stock market crash is possible, the stock market has always recovered. We have historical data to back this up. This is the time to invest for much less and reap massive rewards as the bull market returns. While you don't want to sit on the sidelines the entire time trying to time the market, it is beneficial to be more aggressive when the market is down and others are fearful. This method increases your chances of finding a winner significantly. 7. Do not try to time the market. Everyone, including experts, makes claims and predictions, but no one can predict what will happen in the market. Nobody knows for sure, and no one knows where the markets will go from here. Attempting to do so will result in losses and losses. Ignore the hype and forecasts and stick to your investment strategy. 8. Become an expert in the art of diversification. What you invest in will differ depending on your age and investment horizon. One thing is certain, you should diversify your investment portfolio. You should invest some of your money in stocks, bonds, real estate, or commodities. The idea is that you don't want to put all of your eggs in one basket and instead want to diversify across asset classes. The goal is to help you weather storms and volatility in order to balance your portfolio. 9. Acquire prospectus reading skills. A prospectus is an overview of the company in which you are interested. Prospectuses assist you, the investor, in making important decisions about the stocks, bonds, index funds, fund managers, and companies you are considering. It explains what to look for, fees, information about the company or fund, historical returns, who the CEO is, and much more. These can get quite long, but once you know what to look for, they will become much more manageable. 10. Remove as many emotions as possible. Due to market volatility, investing in the stock market can be a roller coaster, and if your emotions are not prepared, you may make some rash decisions. This is true in both bull and bear markets. Allowing emotions to influence your decisions can result in you losing money, selling and buying too frequently, and negatively impacting your long-term results. That concludes our list of 10 investing tips that all beginners should be aware of before putting their money to work. Even if you're not new to investing, I hope some of these pointers serve as a good reminder.